The currency sell-offs in the emerging markets bring back bad memories of the 1997 Asian crisis. Back then, there were fears of a worldwide economic meltdown. But as Sarah Eisen reports, this time, things are different.
Plunging currencies from Argentina to Turkey to Ukraine are triggering bad memories on Wall Street. It all goes back to 1997, when a sharp drop in Thailand's currency, the baht, set off a chain reaction in other markets, nailing economies in Malaysia, Indonesia, and the Philippines. It sent shockwaves around the world and multiple bailouts from the IMF and even the United States. Investors are wondering, could Argentina or Turkey become the next Thailand? But some on Wall Street say this time is different.
This isn't a crisis level. This is a couple-day sell-off. I'm not sure that it's going to be sustained to affect policy or to affect economic outcomes.
So what's changed? China is a bigger economic powerhouse. Now the world's second biggest economy, its share of the world economy is 4 times what it was in 1997. That means China could act as an anchor of stability if developing markets shake, or cause a lot more trouble if it shows signs of weakness.
There's a lot of capital that's actually come back into China, and that's the point of maximum vulnerability.
Another difference now? The Federal Reserve is in the middle of a balancing act, tapering or scaling back its stimulus it put in place to help fight the financial crisis without disrupting the economy and the markets. The worry for U.S. investors? The world economies are now much more intertwined, and an emerging market meltdown could hit U.S. markets and companies, particularly multinationals, that had depended on faster-growing developing nations for growth.
The big worry is that the EM currencies and the EM countries' share of GDP is much larger than it was back in 1997, 1998. So you had developing countries roughly about 20% of GDP, and then it's now about 40% of GDP. So the ripple effects can be much larger.
And while analysts say brace for more financial swings and turbulence ahead, it doesn't appear to be a full-blown crisis a la 1997 yet. The key will be reaction to the Federal Reserve announcement Wednesday and any news on the health of China's economy. For Nightly Business Report, I'm Sarah Eisen.
Well, here to discuss everything under the sun, from currency turmoil to the Fed to the fate of emerging market economies, maybe even the Super Bowl, is Chris Hyzy, Chief Investment Officer for U.S. Trust. Chris, welcome. Good to have you with us.
How you doing, Tyler?
Let's start where Sarah Eisen left off, and that is with the currency turmoil currently rattling everywhere from Thailand to Argentina to Turkey to South Africa. Is this possibly going to become a kind of contagion that could do really sustained damage to developed markets, or not?
Well, when you take a look at the picture that's going on now versus the mid to late 1990s, as you've referenced, virtually every emerging market had a currency crisis from 1994, starting in Mexico and going all the way to the Russian ruble in 1998, and then again with Argentina and Brazil in the early 2000s. You would say it's back to the future all over again, but the key main difference is, number one, the United States is on very firm footing right now and getting better from a growth outlook perspective. Obviously, from a monetary policy perspective, there's the Fed tapering concerns, so pulling liquidity away from particularly those countries that need it. That's still going to be there. But from a financial contagion perspective, putting what's going on today, making it very similar to back then, complete polar opposites as far as we're concerned. And the other big difference is $17 trillion in cash around the world, Tyler, that's out there, that's very liquid, that's still trying to find a home to invest in for the next few years.
You know, Chris, on Friday, after the markets closed, people were really freaked out going into this weekend. I mean, there's the Dow down over 300 points, and all of this talk about crisis. What changed that today it was just like a normal, middle of the road kind of sell off on Wall Street?
Part of it is the fact that the selling pressure just didn't pull through as much as everyone expected. They tried it around midday when the Dow and the S&P were down, a little around 1% or so. But everyone's pointing to the fact that we haven't had a big correction in the last 12 months. We had a 6 to 7% correction somewhere around the May-June when tapering talk was the first initial shot. Emerging markets never really came back except for that one cyclical episode in the fall. But the reason why it's not pulling through right now is because the outlook for 2014 is a much better growth outlook than last year. Europe is going to grow at 1% versus -1. Japan's probably going to repeat their performance, and the U.S. will grow closer to 3.5 versus 2. So the outlook economically and profits even in fair valued markets, is a lot better this year than last year.
Let's talk about the Fed a little bit. Since they last met, some of the economic data have not been exactly rosy. A poor jobs number today, some housing numbers that were a little bit soggy. Do you think that that will change in any way their proclivity to taper or pull back on stimulus?
Yeah, it really doesn't look that way, Tyler. The only thing that's really going to change their so-called measured tapering under the Yellen Fed is that this particular noise in the system around the emerging markets becomes a contagion. We think that's an extremely low probability event. It's out there, but it's a low probability event. The jobs numbers going back to December, there's a lot of noise in the system, and any 1 month jobs number. When you go back and look at the 3 month trends, they're very robust. And yes, they're not as strong as prior cycles, but I would argue that there's a lot of reasons for that. A lot of it's demographics. The one thing that I think a lot of investment participants are getting wrong is they're looking at the participation rate and they're assuming that people are leaving the job force because they're discouraged. Actually, the growth in jobs is heavier than the growth in the participation rate, so the unemployment rate goes down. That's actually a pretty good thing, and that's why we should see a lower unemployment rate than the Fed even expects by mid-year.
Chris, thank you very much for your insight tonight.
You bet. Thank you.
Chris Hyzy, Chief Investment Officer for U.S. Trust.